What if I told you that most of the money you think you have doesn't actually exist? Not in a vault, not in a digital ledger, not anywhere. It sounds like something out of a science fiction movie, but it's the fundamental reality of our modern economy. Welcome to Finance House, and today we're pulling back the curtain on one of the most powerful and misunderstood concepts in all of finance, fractional reserve banking. This is the story of how banks literally create money out of thin air. It's a system that fuels economic growth, funds our dreams, and builds entire cities. But it also holds the seeds of financial crisis and instability. So how does this magic trick work? And more importantly, what does it mean for you and your money? Stick around, because what you're about to learn will change the way you see banking, wealth, and the very nature of money forever. To understand this mind-bending concept, we need to travel back in time. Long before digital transfers and credit cards, the story of modern banking began with goldsmiths. In medieval times, people didn't want to carry heavy, risky gold coins everywhere, so they'd deposit their gold with a trusted local goldsmith who had secure vaults. In return, the goldsmith would issue a paper receipt, a promise that the holder could redeem it for their gold at any time. Soon, people realized it was much easier to just trade these paper receipts directly, instead of constantly going back to the goldsmith to get the physical gold. These receipts became an early form of paper money. Here's where the genius, or the trouble, began. The goldsmiths noticed something crucial. On any given day, only a small fraction of their depositors would actually come in to claim their gold. Most of the gold just sat there, collecting dust. A clever idea struck them. What if we lend out some of this idle gold and charge interest? They started issuing more paper receipts, more loans, than the gold they actually held in their vaults. As long as everyone didn't rush to withdraw their gold at once, nobody would be the wiser. They had, in effect, created new money. That, in a nutshell, is the birth of fractional reserve banking. They were holding only a fraction of their deposits in reserve. Fast forward to today, and that basic principle still underpins our entire global financial system, just on a much more complex and massive scale. When you deposit, say, $1,000 into your bank account, you probably imagine it sitting safely in a vault, or at least in a designated digital account with your name on it. But that's not what happens. The bank doesn't just hold your money. Instead, it sees your deposit as a liability, money it owes you, but also as an asset it can use. Let's follow that $1,000. Under the rules set by central banks like the Federal Reserve, the bank is required to keep a certain percentage of your deposit in reserve. This is the reserve requirement. For simplicity's sake, let's say it's 10%. So the bank holds on to $100 of your money. But what about the other $900? It doesn't just sit there. The bank is now free to lend that $900 out to someone else. Maybe it's a small business loan, a car loan, or part of a mortgage. Now, here's where the magic really happens. The person who borrowed the $900, let's call her Sarah, uses it to buy something, let's say some equipment from a supplier. She pays the supplier, and that supplier deposits the $900 into their own bank account. And what does that bank do? You guessed it. It keeps 10% in reserve, that's $90, and lends out the remaining $810. That $810 is then spent and deposited into another bank, which then keeps 10%, $81, and lends out the remaining $729, and so on and so on. Let's stop and look at what just happened. Your initial $1,000 deposit is still in your account. You can spend it whenever you want, but now Sarah has $900 she didn't have before. The equipment supplier has $810, and the next person has $729. From your single $1,000 deposit, the banking system has created $900, then $810, then $729, and this process continues, with each loan creating a new deposit elsewhere in the system. Your original $1,000 has been multiplied, creating thousands of dollars of new money that flows through the economy. This is called the money multiplier effect. In theory, a 10% reserve requirement could allow an initial deposit of $1,000 to create up to $10,000 in the economy. It's not printing money in the traditional sense. It's creating credit, which for all intents and purposes functions as money in our modern world. This system is overseen by central banks, like the Federal Reserve in the US or the European Central Bank. They are the puppet masters of this money creation process. They have two primary tools to either encourage or slow down this process. The first is the reserve requirement we just discussed. By lowering it, they allow banks to lend out a larger portion of their deposits, injecting more money into the economy. By raising it, they restrict lending and cool things down. The second and more commonly used tool is the interest rate, specifically the rate at which banks can borrow money from the central bank or each other. When the central bank lowers interest rates, it becomes cheaper for banks to borrow, which encourages them to lend more money to consumers and businesses at lower rates. This stimulates economic activity. When they want to slow down the economy and fight inflation, They raise interest rates, making borrowing more expensive and slowing down the pace of money creation. So, this system is the engine of modern capitalism. It allows for the massive expansion of credit needed to fund everything from student loans and mortgages to corporate investments and government debt. Without fractional reserve banking, the economy would be far smaller and less dynamic. It allows capital to be allocated to where it's needed most, fueling innovation and growth. When you get a mortgage to buy a home, you're not borrowing someone else's life savings. You're borrowing money that the bank essentially created for you, based on its ability to do so within the system. It's a powerful tool for prosperity. But, as with any powerful tool, it comes with significant risks. The entire system is built on one very fragile foundation: confidence. It works only as long as we all believe it works, and as long as we do and all run to the bank to withdraw our money at the same time. This is what's known as a banker run. If rumors spread that a bank is in trouble, depositors might panic and rush to pull their cash out. But remember, the bank only has a small fraction of that money on hand. It can't possibly pay everyone at once. This panic can become a self-fulfilling prophecy, causing even a healthy bank to collapse. This is exactly what happened during the Great Depression, when chains of bank failures wiped out the life savings of millions. To prevent this, governments created deposit insurance programs like the FDIC in the United States. This guarantees that even if your bank fails, your deposits are safe up to a certain limit, currently $250,000 per depositor. This is a crucial backstop designed to maintain public confidence and prevent bank runs. Another inherent risk is the business cycle of booms and busts. When interest rates are low and credit is cheap, money is easy to create. This can lead to economic booms, but also to asset bubbles. People and companies borrow excessively to invest in things like stocks or real estate, pushing prices up to unsustainable levels. Think of the housing bubble that led to the 2008 financial crisis. It was fueled by years of easy credit created through this very system. When the bubble inevitably pops, loans go bad, banks face massive losses, and the money creation process slams into reverse. Credit tightens, businesses fail, and a recession can follow. The system that amplifies growth on the way up also amplifies the crash on the way down. And then there's inflation. When banks create a lot of money very quickly, you have more money chasing the same amount of goods and services. This can devalue the currency, meaning your dollar buys less than it used to. This is the classic definition of inflation. Central banks walk a tightrope, trying to encourage enough money creation for healthy growth, without letting it run wild and cause runaway inflation. It's a delicate and often difficult balancing act. So the next time you swipe your card or check your bank balance, remember the invisible system working behind the scenes. That number on your screen is part of a vast, interconnected web of credit and debt, a system of money creation invented by medieval goldsmiths and now powering the entire global economy. It's a system of immense power, capable of generating incredible wealth and progress, but also one with inherent fragility and risk. It's not a conspiracy, it's just the complex and often counterintuitive way modern finance works. Understanding it is the first step toward navigating the financial world with more clarity and confidence. Thanks for joining us on this deep dive at Finance House. If you found this explanation helpful and want to unravel more mysteries of the financial world, make sure to hit that like button and subscribe to our channel. We love hearing from you, so drop your questions or thoughts in the comments below. See you in the next video.